After years of benign volatility and significant returns, 2018 has been a very different story. For the first time in a very long time, all the major asset classes, stocks, bonds, and commodities have faced periods of negative returns year to date. Hi, I'm Travis Robinson and I work within our financial advisor channel management team at S&P Dow Jones Indices. And joining me today to discuss how advisors are navigating these rough market conditions are HD Wealth Strategies, Allie Schmidt and Steven Higgins. Welcome, Steven, Allie. Thank you for joining me today.
Thank you, Travis.
So you guys work with a number of pre-retirees and retirees. Is this perfect storm the biggest challenge you're facing this year?
Mm-hmm. Yeah, great question. In fact, yes, it is the biggest challenge we're facing this year, but probably not in the way people would think. Market corrections, 10%, in the neighborhood of 10% corrections like we're feeling right now, aren't unique and they're not new. And historically they come around about once per year, like we like to say in the office. They come around about as often as Christmas. So yes, it is providing a challenge themselves, but the challenge isn't necessarily unique.
Yeah, and I think realistically the challenge that we see a lot, in addition to that, is just what does an asset allocation for a client, what role does that play in their portfolio? Mm-hmm. And trying to understand, diversification, because I think that diversification can be difficult to navigate over long periods of time, because realistically it actually doesn't feel very good, because when the market's up you tend not to be up quite as much because of that non-correlative piece, kind of those little bit safer pieces in the portfolio. Mm-hmm. And then on the flip side, when markets as a whole are down, our clients are still down, right? Of course, they just aren't down quite as much. So trying to understand and deal with just the emotional impacts of owning diversified portfolios and really be able to figure out a way to communicate how important really that asset allocation over time is.
Right, and we understand that we're managing capture ratios of our clients' portfolios. Sure. Yeah. We're trying to find the most efficient way, the least volatile way to get from where they are today to meeting their long-term goals. But I'll tell you that the biggest challenge isn't the portfolios themselves, it's keeping the clients focused on the long-term goal rather than today's headlines.
Yeah.
So sounds like a deeper advisory relationship. Sure. But what else does that look like in practice for you guys?
Travis, I think the concept of advisory itself is new to many investors. Historically investments have been sold, and they've been sold based on a sales process that appeals to emotions, either fear or greed. Now, in an advisory practice, we don't depend on transactions or commissions. An advisory practice and relationships like the ones we have with clients depend on that attainment of long-term goals.
Right. And really our practice, because we are an advisory firm, our practice is really built on the foundation of financial planning. And our goal is really to be able to help clients focus on what they're actually trying to do and make that financial plan, whether that's, retiring on their own schedule, whether it's sending a son or daughter to school, and really make that the primary focus. Right. Because when we're able to do that, then we're able to put together a portfolio that has some volatility, but at least we're able to give it a little bit of context to make sure that whatever that volatility is actually needed in order to meet those goals.
Right. Yeah, that's right. And unfortunately, when an investment is sold and all of its nifty features are sold in the very beginning, clients are left to be disappointed when the investment maybe doesn't perform like they thought it would. And our job as advisors is to explain to our clients using the historical data and the indices to show what a normal ride is like in an investment, through the good, through the good and the bad, during the volatility, before and after.
Exactly, and it's really nice for us, even in times like this actually. It allows us to stress test clients a little bit, right? Where we're actually able to get a little bit of feedback on how they're responding to the current volatility that we're in. And realistically, with where we've been in 2018, if this is the type of market volatility for that specific client and that specific portfolio, if that's causing sleepless nights and severe heartburn, maybe it's not the right spot. Right, or maybe we should look and see, is there another plan maybe that has a little bit less volatility that's going to be able to reach those goals?
Right.
So.
Yep,
that's right.
A little stress testing can go a long way. Huh?
Exactly.
And it's hard to believe 2018 is almost over, right? We're in December now. So as you look ahead to 2019, how are you using index data to position yourselves for the new year?
So, we actually use indexing day to day in our communications that we have with clients. We use it to just give a little bit of that context to what we're talking about. And we actually even use it a lot in the office, just in our conversations, just kind of furthering our knowledge as well. And one specific piece that we use every day that has been really helpful is that daily dashboard that you sent. That's really helpful for just kind of that snapshot of what are all of these individual indexes doing on different time frames. That's been really helpful.
Right, and as we move into 2019,
Yeah.
we're going to use the data in the indices to make sure that our portfolios are positioned correctly to make sure that we're able to, I guess, meet the client's expectation. And then using that same portfolio data, the same indice data, we're going to be continually communicating with our clients. For example, we're going to blog several times a month and using the same terminology, the same data that is referenced in our portfolios. We just feel like that repeated and consistent confirmation with our clients and setting of expectations over time just gives them a much better backdrop of context as we go through what we believe will be continued elevated volatility.
Yeah, that's a really good point because when you look at 2018 and you say, is it more volatility than recent memory? Absolutely, right? I mean, we certainly have had more of that. However, if you look over a longer period of time, is it abnormal or is it extreme?
Right.
And no, it's really not. I mean, it's really fairly normal. And I think that we as advisors and we as clients we need to make sure our clients are ready for more. Because sometimes volatility is necessary, not sometimes, all the time, volatility is necessary for people to be able to meet those goals. And we've just realized that in the past, we've been able, when you have those conversations prior to these moments, when these moments are very volatile, and we take the time to talk about what pullbacks look like, what they feel like to a certain investor's individual portfolio, by having those conversations, prior to, we're really able to get the clients on board to understand, yeah, maybe this is normal and I can stick to the plan because I see the purpose, right? I see that future goal.
Yeah.
Right, and Allie, earlier you mentioned the idea of stress testing our clients.
Right.
And I can appreciate that because this opportunity does provide a moment where we can really see how our clients are able to handle the goals and strategies that we've helped them set. And as the market moves and they exhibit those emotions, maybe what we need to do is re-examine the portfolio and rework that for them so that they have more of a portfolio that, number one, can meet their goals, and number two is something that they can hold on to. Right. Just the challenge over time is either having a portfolio that's too risky for somebody, as well as having a portfolio that's too conservative. And I think if you have those conversations using the indice and data, you can just develop better expectations, in something that's going to be more practical for a client over time.
Exactly. Yeah. Being too conservative is a risk as well.
Too much or too little.
Exactly.
Yeah.
Right. Where's the happy medium?
Yeah. Well, Steve, Allie, thank you for joining me today.
Thank you, Travis.
Thank you, Travis.
For more information on S&P Dow Jones Indices and benchmark resources, visit spdji.com. Thank you for joining us today.